Hello students, you are the future chartered accountants of India. This is CA Abhijith Acharya. Welcome you all for Abhi CA Classes. We have discussed till part 2 of this PGBP chapter. Today we are continuing with the same chapter with the next slides. Okay, without wasting further time, we'll discuss the next topic, that is depreciation for power generating undertaking, the sale of assets or SLM method. We have already discussed that for power generating units there is an option to claim a depreciation under SLM method. They have that option. For other SSEs, they do not have any options like SLM method. They have to follow the WDV method. For power generating units, they have an option to claim a depreciation under SLM method, that is straight line method. In that case, the following situation will arise. If power units follows SLM method, then they are subject to individual asset system profit and loss and is calculated on every sale. If any of the asset has been sold out, then we have to count the profit and loss on the sale on individual basis. If you follow that WDV method, then we will see that profit and loss account on the basis of block of assets. But here we have to see every asset we have to count. Okay, so for better understanding, we have given one of the basic examples. The cost of the asset is 100 rupees. SLM depreciation rate is, let's assume, 10%. The asset is sold in the third year of the put to use, and sale price respectively in three cases, that is 75 or 85 or 120. Okay. First we have to count, we have to compute the WDV on third January, so third year, right? Because that has been asset has been sold in the third year, so we have to arrive at the WDV as on the third year, right? So the actual cost is 100 rupees. The first year depreciation 10% is 10 rupees minus 90 rupees. Second year depreciation also the same method, the 10% 10 rupees. The WDV as on the as on the beginning of third year is 80. Okay, we'll see the first case. The first case says the selling price is 75, right? The selling price is 75. The WDV just we have computed is 80, but without seeing, but we can see that there is an arises of actually term, that is what do you call, that is loss, that is capital loss. But if you follow that SLM method by the power generating unit, then we have to count as a terminal depreciation, and hence it will be allowed as a deduction, it will be allowed as an expenses, can be debited to your profit and loss account. Okay, so this is the case. Next is case number 2. The selling price is 85. The WDV as computed is 80. So there arises a gain. It seems to be a capital gain, but it is not a capital gain, especially in this case. So it will be considered as balancing charge. So it will be credited to your profit and loss account. It will be generally treated as PGBP income. That's it, not as a capital gain. Okay. Next, case number 3. The sale value is 120. Let's assume it is more than cost of the asset. Cost of asset is 100, but selling price is today on the third year is 120, right? And hence the WDV that we have just computed is 80. So the gain will arise as 40. So we have to categorize this gain as capital gain, and that balance will as balancing charge. Why only for this case? Because you can see in the case number 2, this cost is less than its selling price is less than 100, its cost price. But in the third case, the selling price is obviously more than its cost price, right? 100 its cost, but selling price is 120. So there would arise the capital gain concept to the extent of selling price minus actual cost price. Okay, actual cost price means what? 120 is the selling price minus cost of the original asset is 100. Okay, the 20 rupees will come as a capital gain. That will be start term capital gain under section 50A. The balancing figure up to the cost of asset is there. No, that will be considered as balancing charge, just as per the same as case number 2, would be credited to your profit and loss account. I would once again revise. If there arises any loss, would be treated as terminal depreciation, debited to your profit and loss account. If would actually if any gain would arise, then it would be treated as the balancing charge, would be credited to your profit and loss account. and if its selling price is more than cost, original cost, then to that extent that will be considered as short-term capital gain. Balancing figure would be obviously considered as the balancing charge would be credited to your profit and loss account. This is the brief explanation. This would be applicable only in the case of power generating opting for the SLM method. That's it. If they are opting for WDO method, then this concept will not arise. Okay. Next, section 38, subsection 2. Asset, if any asset is partly used for other purpose, then if asset is partly used for business or professional purpose and partly used for other than business or professional, let's say for example personal purpose, then the deduction under section 30 or 31 or 32, that we have just gone through, shall be restricted to the proportionate part as determined by the AVO. AVO means assessing officers. Let's assume the WDV minus opening balance is equal to 1 lakh minus car. For example, the WDV, the car is used, the 60% of the car is used as for the business purpose, the 40% of the car is used for personal purpose. Then the depreciation rate on the cost of the asset is 1 lakh. Okay, the 15% is the depreciation rate as per our list. It is a motor vehicle, not coming in the 30%, 40% higher charges. Let's assume it is normal car using in the business purpose to the extent of 60%. So 10 lakh into 15% into 60%. 60% why? Because it has been used for business purpose only to the extent of 60%, right? So 10 lakh into 15%, that comes to 1,50,000 into 60%, that's 90,000 is allowable as a deduction, as a depreciation. Okay, the remaining 40%, that is 60,000, it's been fully disallowed because it is used for personal purpose in this example. Okay, so closing WD of the car would be 10 lakh minus 90,000. 90,000 why? Only the allowable depreciation we have to count. So 9,10,000 would be the WDV, would be form part of your balance sheet. Okay, as per the taxation rules. This is simple question. Next, the section 35, the expenditure on scientific research. Some expenditure would be incurred on the scientific research calculations also. In that we'll see the two categories. First, part A, that is in-house research. If you are a SSE who are contributing in-house, you are making scientific research in-house in your own organization. You are self-spending on your own for the research activities. In that case, the second part B says that the contribution to the outside research organizations. First, we will see the in-house research organizations. Okay, what do you mean by the expenditure on scientific research? I will revise in brief. I will explain in brief. If you contribute any of the any of the expenditures in with regard to that scientific research, then that would be fully allowed as a deduction and would be debited to your profit and loss account as per the taxation rules. Okay, so in which cases we'll say now. First, the research, if you are making expenditure on in-house research organization, then there would be two categories. First, the research after the commencement of business. First, you will commence your business. After that, you are going to research on any of the subject. The second thing is the research. Before commencing your business, you are starting the research activities, but the as per Income Tax Act, it says only up to the maximum 3 years before the date of commencement. Let's say, for example, 1st for 2023, you have started your business. Before maximum 3 years before the date of commencement means before 1/4 up to 1/4/2020. From 1/4/2020 to 1/4/2023, if you have incurred any expenses with regard to that research activity, that would form this part. Okay, I hope you are understanding. So first we will see the research after the commencement of business. The SSE should be, if the SSE is a company, is engaged in the manufacturing or biotechnological business research engaged in the manufacturing or biotechnology business research approved. This should be an approved from the research organizations. Okay, the section 35 2AB, it will be classified as if you incur an expenditures under revenue nature, then 100% deductions would be allowed. 100% deduction means it would be form of your profit and loss account. If you are incurring a capital expenditure, then in respect of any land, no deductions would be available. In respect of building, the 100% deduction would be available. What do you mean 100% deductions mean? Means if you're actually, if for let's say example, building cost is let's say for example 100 lakh. Okay, you will get the 100% deductions of 100 lakh. Entire 100 lakh would be a form of your revenue nature, and hence the WDV of that building would be nil in your balance sheet as per the taxation rules, because entire cost would be treated as an expenses, so it would be form of your profit and loss account as an allowable expenses, and hence its cost or WDV would be nil. Okay, it's a simple concept. Next, if you are incurring any other capital expenditure in respect of plant and machinery or any other furniture, any other required capital expenditure, then also 100% deductions would be available. Okay, this is respect of company, manufacturing or biotechnology business. Next, we will see for other SSEs. Other SSE in the sense not a company or company not having in this business activities. Okay, other SSEs means if you are incurring if you are individual, if you are incurring any revenue expenditure, then 100% deduction would be available. If you are incurring any capital expenditure in respect of land, no deductions. In respect of other capital asset, the 100% deductions would be available. Okay, there is no 100% deduction means it would be entire amount of cost would be treated as an allowable expenses, and hence the WDV would be nil in simple terms. Okay, next, if you are, as I have already said, if you are incurring a research expenses in between 1st April 2020 in our example till 1st April 2023, when you are starting your business, on which date you are commencing your business, till those period it would be considered here. If you are incurring any revenue expenditure, if you are paying any salary, excluding, I am highlighting that word, excluding the perquisites, because perquisites, in respect of perquisites, you will not receive any of the deductions. Okay, in respect of any salary, the 100% deductions would be available, excluding perquisites. So remember, excluding perquisites. In respect of other revenue expenditures, not allowed. Very strict policy. Only with regard to the salary, excluding that perquisites, then that will be available as a deductions entire. If you are, for example, let's say in your profit and loss account, any other expenditures apart from that salary, let's say for example rent paid, that would be disallowed, even though it would be a form of your profit and loss account as per your books of accounts, as per your taxation, it would be added back to your profit. It would not be treated as an allowable expenses. Only salary, excluding the perquisites, would be a part of allowable expenses. Okay, in respect of capital expenditure, in respect of land, not allowed. Wherever this comes, the land expenditures would be not be allowable as a deductions. Okay, and in respect of other capex, in respect of other capital expenditure, then 100% deductions would be available. Okay, that means it would be a part of your profit and loss account, even though you are not debited it. As per the Income Tax Act, you would be debited. Okay, but as far as your balance sheet, it would be nil as per the taxation perspective. Okay, I hope you are understanding. Next, part B. If you are not expending on your own research activities, if you are simply contributing to the outside research organization, then also under PGBP you will claim deductions. You will claim they would spend this as an allowable expenses. First, if you contribute to approved research associations, to approved colleges, to approved institutions, to the approved university. There are 4 criteria: RCUIU. Okay, to approved research organizations, approved colleges, and approved institutions, and approved university. Then, if you are contributing in respect of only scientific research as well as for social statistical research, any of the researchers, but the focus should be scientific research or social statistical research, then 100% deductions would be available There is no bifurcation of capital expenditure, revenue expenditures. The entire contributions made by you in respect of those approved organizations, in respect of the scientific research or social statistical research, would be 100% deductions would be available. Okay. Next, if you are contributing the IIT or national laboratory for scientific research, then 100% deduction would be available. IIT or national laboratory, the for scientific research organization, there would be 100% deduction would be available. Two, if you are contributing to the approved Indian company, this word is very important. Approved Indian company engaged in R&D, research and development activities only for scientific research, then also the 100% deductions would be available. If it is a foreign company, then no deductions would be available. Okay. Next, there are some key points with respect to this the scientific research section. That is section, let's say section 35. Okay, uh, the depreciation on assets would not be allowable if 35 AD is claimed, because it is logical, right? If you, even the 100% deduction is available for those of the categories, because your if a cost minus 100% deductions, obviously the WDV will be nil, and hence the concept of depreciation would also not arise in this case, and hence in order to revise you, the depreciation would be nil in this case if you are claiming the deduction under section 35 AD. Okay. Next, the depreciation means the entire expenses can be claimed as a revenue expenditures even though their capital nature, hence WDV would be nil. The same concept. That's deductions, not deduction means, okay, the deductions under section 35 is available only if he is opting for normal tax regime. If the SSE is opting for 115 BAC, that is a new tax regime, then this section would be not valid. It should be invalid. You should ignore this of the provisions. And if you are claiming opting for the section 115 BAC, there is a new tax regime. The unabsorbed research expenditures will be there. No, the last years can be set off and carried forward the same as unabsorbed depreciation, that is to the n number of years. Okay, this is the four important points that you should keep in your mind in order to revise. Next, there is a simple section, that is section 35. Section 35 says the preliminary expenses. What do you mean preliminary expenses? Which would form a part of preliminary expense? What do you mean by the definition of preliminary expenses? The preparation of feasibility study, project report, market survey, engineering services. If your examiner gives you any of these, then it would be a form of preliminary expenses. Then you should apply the concept of section 35D. Okay, drafting and printing of memorandum of association or articles of association, that I hope you have studied in your foundation, that is in the law subject, mercantile law. Legal fees or expenditure related to public issue of shares on debentures. Other expenses may be notified by CBDT. Okay, these would form a part of your preliminary expenses. Okay, the deductions allowed to resident SSE only. Remember, who are resident, we have already discussed in the chapter 2. If you have forgotten, please go and revise, don't worry. Deductions allowed to resident SSE who incurs preliminary expenses before the commencement of business. Preliminary, that means it indicates the preliminary, pre-incorporation expenses, in the sense, or after, it might have some of the expenses would have been incurred after the commencement of business also, for extension purpose or for setting up a new unit. Okay, the same business who wants to set up a new unit or who wants to extend his business, then also these expenses can be occurred. So the deductions would also be given for those of the SSAs, those of the expenditures which have been incurred after the commencement of business. Okay, don't worry. But the amount of deductions would be, if you are an Indian company, if you are an other resident individual. If you are an Indian company, the deductions would be lower of the below. The actual expenditures incurred or higher of the below. 5% of capital employed, sorry, cost of project, COP means cost of project, or 5% of capital employed. First, you have to see the higher of 5% of cost of project. What do you mean by cost of project? We'll discuss in brief in afterwards. This after this formula. First, you have to see the 5% of cost of project or 5% of capital employed. Whichever is higher, that higher amount should be compared with actual expenses. The both should be compared, and whichever would be lower will be treated as your amount of deductions. You can be claimed as a deductions, which is allowable deduction. That's it. First, you have to see the higher of 5% of cost of project or 5% of the capital employed. The higher amount should be compared with actual expenditures. Among them, whichever is lower should be treated as an allowable deductions. If you are an other resident individual, other resident SSEs, the deductions will be actual expenditures or 5% of the cost of project, whichever is lower. Simple. Here you have to see twice, here only one time. The above deduction is allowed in 5 equal installments. The deductions amount will be there. No, the entire amount should be apportioned in 5 years. It can be claimed in 5 upcoming years, including this 5 year, including this first year. The next 4 years you can utilize that. For let's say for the amount reduction would be 1 lakh, the 20,000 each year you can claim from this year. That's simple. That's simple and apportionment. That's it. The cost COP means the cost of project, the amount invested in fixed asset of a new project or extension of an existing business. That's it. If you are investing in any capital asset purpose, that's called a cost of project. Then capital employed means the share capital plus debenture plus long-term borrowings of new project or extension. Only these three would form of part of your capital employed. Then reserves, and if in your balance sheet reserves and surplus is there, then you should ignore that. Then audit is mandatory. Now to claim this deduction, the audit is mandatory by the respective chartered accountants as specified, and it is mandatory for the year in which such expenditures are incurred, except for the company or cooperative societies. If you are SSE or if you are the SSE is being the company or cooperative society, then audit is not mandatory. If the SSE is being other than these two SSEs, then the audit is mandatory by the respective chartered accountants. Okay, simple. Then section 35 DDA, the expenditure incurred on voluntary retirement scheme, that would be reduced. We have discussed the same in the topic of salary, but that is in the form of the employee. We have seen from the perspective of employee, but we are now seeing from the perspective of the business. SSE applicable to all, this would form a part of your all expenditures. The any expenses incurred would be claimed as a deductions, but in 5 annual equal installments. Let's say for example 50,000 is an expense incurred on the voluntary retirement scheme VRS, then there should be a portion into 5, that is 10,000 for each year, including this year in the next upcoming 5 years. Okay, simple. Please revise 35D and 35 DDA. The amount of deductions would be apportioned in equal 5 installment. For rest sections, this concept is not there. The entire deductions can be claimed in one shot. That's it. Only for these two, that apportionment should be kept in mind in your mind. Okay, next notes for section 35D and 35 DDA. If there is any amalgamation or demerger, then remaining deductions. Let's say for example, 2 years. In our example, 50,000, 10,000 each in 5 years. At the end of second year, their company is being amalgamated to the new company, amalgamating company. Then the balance 3 years ka portion, that is 30,000 in our example, would be transferred to amalgamated company. Okay, not amalgamating company, amalgamated company or demerged company or resulting company. That's maybe. I hope you understood. That carried forward, the balance amount would be carried forward to the resulting company or demerged company or amalgamated company. Simple. Only for these two sections. Next, very important section 35 UAD. Specified business, optional for SSE. Why it is mentioned as option? This is an option. The SSE can claim as a deductions, or SSE can simply put that amount in his balance sheet. That's it. If an SSE is claiming any deductions is an option. It is not mandatory as per CBDT, as per Income Tax Authority, Income Tax rules. First, there are I think 1 minute. There are 14 special businesses. If you are carrying these 14 business, then any expenditures incurred would be a part of deductions, can be claimed as deductions. But it depends on your options. It depends on your perspective. If you are not claiming a deductions, it's your mercy. If you want to claim the deductions, it would be whole part of the deductions, and hence the WD would be nil if you are claiming deductions. Which and or the form part of their special business. First, setting up. If you are engaging in a business of setting up or operating cold chain facilities, then that commencement date should be, if you are commenced your business on 1st of 2009. I have mentioned the business type. The commencement date means from on which date that business should have been started, so that this deductions can be availed. 100% deductions. First, setting up cold chain facilities, first for 2009, 100%. Let's say, for example, if you are started your business, that cold chain facilities on first for 2008, then deductions would not be given. Even though it is optional, even though you are willing to opt, this is not be given, because if you have only started your business in 2008, prior to 2009, and as the deductions would be nil. Okay. Next, if you are engaged in the business of warehouse facilities for agriculture produce, then the date would be the same 1 for 2009, the 100% deductions. Next, laying and I am simply going through, but while revising, please be sure in your mind which will be which will be considered as special business. I have highlighted that cross-country pipeline for distribution of petroleum, oil, natural gas. If you are engaging in this business, the business day should be first for 2009, 100%. Next, building and operating a hotel of 2-star or above. If you are running an hotel, that should be 2-star or more, but that should be business should be commenced on hotel should be commenced on first for 2010, 100%. Yeah, then if you are if you are starting in a hotel or hospital facility with minimum 100 patient beds, there should be minimum 100 patient beds, then only it will be treated as special business. First for 2010, 100%. Next, developing and building a house project under a slum redevelopment or rehabilitation program, that should be first for 2011, 100%. Then production of fertilizers in India, if you are engaged in the business of production of fertilizer, first for 2011 onwards, 100%. Setting and operating an inland container depot or container freight station, the business should be first on or after first for 2012, 100%. Developing and building a housing project under affordable housing scheme, 1 for 2011, 100%. Beekeeping on the production of bees, honey and wax, then 1 for 2012 onwards, 100%. Then setting up and operating a warehousing facilities for sugar. Of course, we are discussing agriculture produce, but here we are discussing the sugar. Then 1 for 2012, 100%. Then laying and operating a slurry pipeline for transportation of iron ore, 1 for 2014 onwards, 100%. Setting up and operating a semiconductor wafer fabrication, water fabrication or wafer fabrication, I'm not, and manufacturing unit, 1 for 2014, 100%. And developing or maintaining operating a new developing maintaining operating a new infrastructure facilities, that would be first for 2017, 100%. These are considered as special business. Once again, go through the same. Okay, but there are some key important points with respect to the special business deduction concept. Not formed. If your business is forming by splitting or reconstruction of existing business, then the deductions would be nil. Even though you are actually eligible under the special business, but if your business is reconstructed or splitted, then this deduction would be nil. The business should be new. That's it. Next, the plant and machinery should also be new. Exception. There are some exceptions. First one, the plant and machinery was imported to India Out of that, the depreciation not been claimed under Section Income Tax Act 1961. If that plant and machinery has been brought to India, that has been imported to India, on which the depreciation have not been claimed yet, then that can be used on which you can claim deductions. Even though the concept is new is there, but import in terms of import that is not applicable. But remember, the depreciation should not have been claimed under Income Tax Act. Okay. Second, the 20% of the whole plant and machinery cost can be seconded. Let's say, for example, 1 lakh in your block of assets is entire value of the plant and machinery, out of which the 20,000, maximum 20,000 can be worth of plant and machinery can be old, that can be seconded. The remaining 80,000 should be a new one or imported one, as the case may be. I hope you are considered, because the next deduction is allowed on all capital expenditure except the goodwill, land, and financial instrument. Financial instrument means shares or mutual funds or any of the units, etc. Deductions can be claimed only for the capital expenditures, not on revenue expenditures also, and except for goodwill also, land also, financial instrument also, this deductions would not be claimed, cannot be claimed. Okay. Next, the deductions is not allowed if any expenditures in respect of which the payment made to person in a day exceeding 10,000, otherwise than through account paycheck or daily or use of any electronic clearing system, ECS in short. For example, if you are incurring an expenditure on respect of any plant and machinery, let's say for example 20,000, let's say 20,000, let's say, but you are making you are incurring that expenditure only through cash, then the deductions would be nil. Okay. In order to promote the cashless transactions, this concept has been brought into effect. That's it. The depreciation is not allowed if Section 35AD is availed. We have already discussed it, because the WD would be nil if you are claiming a deductions. Next, the loss of specified business can be carried forward indefinitely. If you are incurring any loss out of the specified business, the loss can be carried forward to the n number of years. That's it. Next, if SSE, but the return of income, if you should file your income tax return within the due date, that's it. If you are filing an income tax return after the due date, then the deduction, that specified business loss cannot be carried forward. That's it. If SSE on which Section 35AD is claimed is being sold, very important, is sold, then entire sale proceeds should be taxed under PGBP, not under capital asset. Because you are claiming a deduction under PGBP chapter, and hence the selling amount should also be computed, should also be taxed under PGBP head only, not under capital gain. That's it. I have discussed the loss of the specified can be carried forward. How to set off the loss of that specified business can be only set off only against the income of other special business. Well, let's say for example, I am having two business. One is special business, another is other than special business. I cannot utilize the special business loss against income from normal business. Okay, it should be utilized only with the special business, not under any of the 14 category. For example, in the first year, you are engaging in a business of that cold chain facilities, you are incurring some loss. In the second year, you are closing that business. If you are starting the manufacturing of sugar facilities, in that you are earning an income. That loss of previous cold chain facilities can be set off here, but that loss cannot be set off against other than special business. I hope you are understanding. I am simply revising. The specified business loss cannot be set off against any other business other than special business, but that can be set off other than the same types of special business. In my example, that I have incurring a loss from cold chain facilities, I am having any other specified business of warehousing facilities for sugar or any other agricultural produce, that also considered as specified business in our list. Then that loss of cold chain facilities can be set off against that sugar business, because that is also considered specified business, right? This concept is says like that. Loss of specified business can be set off only against the income of the same specified business or other specified business, irrespective of the fact the latter is not eligible for Section 3580. Let's say, for example, that here actually we have mentioned, I have narrated one example. I am incurring a loss of cold chain facilities, let's say for example 50,000. I am also having one more specified business of warehousing facilities of agricultural produce, but that has been commenced from with the effect from 1/4/2008, in respect of which the deductions would be nil. But that is also considered a specified business. Any income, let's say for if you are incoming, if you are earning 1 lakh income from that agriculture produce business, that has been commenced on 1/4/2008, that loss of 50,000 cold chain facilities can be set off against the specified business of agricultural produce, even though the Section 3580 is not applicable for agricultural produce. Why? Because the 1/4/2008 it has been commenced. Right. Let's say for example, even though you are not eligible for that business, that should be a specified business, that should have been a specified business, but the deductions cannot be claimed in respect of that agriculture produce business, but the loss can be set off against that specified business. I hope you are understanding. Next, some important point is, if 3580 is claimed, the deduction under Section 80IA to 80 RRB, Section 10AA shall not be allowed, which we'll discuss in the next upcoming chapters. Okay. Section 35 is available. Section 35 is not available if SSC is opting for new tax regime, that we have already discussed. If you are opting for new tax regime, Section 115 BAC in respect of individual or HUF, 115 BAA or 1 BAB in respect of company assessees, that 35AD would be nil. Okay, infrastructure facilities. I have discussed the concept of infrastructure facility. Means the road construction, road including toll road, bridge or railway system, highway project including housing or other activities being an integral part of the highway project, and water supply project, irrigation facility project, sanitation, sewerage project or solid waste management system, the port, airport, inland waterways, inland port or navigational channel. See, these can also be treated as infrastructure facilities. If you are engaging in these or any of these business, and then we will also be considered as a specified business. Okay. Next, asset on which Section 35AD is claimed, this is very important, should be exclusively used for that business for 8 years or more from the date of acquisition. It should not be diverted to any other specified, any other business not under these 14 categories. Okay, that should be exclusively used for that business only or that specified business only. That means if it is used for non-specified business within 8 years, then the following shall be taxable as PGBP. There is one restriction is there. Amount of deduction claimed as a deduction under Section 3580, that's simply a cost of asset. The cost of asset 100% deduction would be available. No, that you should take here. That will be added back as an income to you if you are using that business within 8 years to non-specified business, minus that will be reduced by the depreciation would have been allowed if Section 135 is not claimed. If we have not, even though it is although it is treated as an optional, if you are not claiming Section 135 AD deductions, then what would be the deduction depreciation amount if you are not claiming that Section 35 AD? That would be reduced. Okay, you have to consider the notional depreciation. Okay, for let's say for example the asset value is 100. On third year you are transferring that asset to non-specified business. Here 100 you have claimed as a deductions in the year of acquisitions. That you should take, reduced by the depreciation would have been claimed. Let's say for example 15% is the rate of depreciation. 15% for 3 years on WDV method should be computed. That should be reduced from 100 rupees. That would be treated as a taxable PGBP. Simple. Then note, the above provision is not applicable if the company becomes a sick industrial company. If that company becomes a sick industrial company, then this taxability would not arise. If SSE is transferred, asset is transferred from specified to non-specified, then actual cost for non-specified business would be the same. The actual cost, that is in our example 100 minus notional depreciation, that's 15% for 3 years. We have to reduce the remaining would be the WDV for the non-specified business. Let's say whatever the PGP income that has been taxed, that would be treated as a cost for the transferee company. Okay, that is non-specified business. This till now we have discussed the concept of 35D, 35AD, of the very vast concept in this whole chapter, PGBP chapter. This would be a form of very wonderful mark if you concentrate on this section, especially in these sections. So afterwards we'll discuss the next topics in the next part of this chapter. Next part of this chapter, be tuned in this the series, and please revise the concept again. And signing off, see Abhijith Acharya, Abhi CA Classes. Hope and have a nice day.